Wealthy and Wise is your guide to value investing, powered by Teaminvest.
Hello there, and a very warm welcome to Wealthy and Wise on Ausbiz. I'm Nadine Blaney. This isn't a show about chasing the next hot stock. It's about a smarter way to invest. Together with Teaminvest, we'll be unpacking what value really means, how to read businesses instead of headlines, and why price and value are rarely the same thing. In today's program, we will start at the beginning. We'll figure out what value investing actually is. We'll consider how Teaminvest thinks about risk and growth. And we'll put three well-known companies under the microscope: Kohl's, CSL, and Life 360. Plus, we'll tackle your questions, especially as reporting season heats up. The goal is simple: to help you think like an owner, not a trader, and build wealth with a clear, repeatable process. And joining me today to delve deeper into value investing, Andrew Coleman from Teaminvest. Andrew, welcome. So when people think about value investing, they often just think cheap stocks, right? So when Teaminvest is thinking about value, what are we really talking about?
It's a great question, and I think it's one of these terms that has become co-opted over the years so much by its detractors and turned away from what it really is. I mean, I think the reality is anyone who is investing in the market, which means, and we'll define that a little bit later, the difference between investing, trading and speculating, but anyone who's investing, anyone who's holding an asset with the hope that that asset will over time deliver them more than it's worth, is by definition value investing. Because at the end of the day, really all value is separating the concept of what something gives you, that's its value, from its price. So if you think about buying a car, the cost of the car is its price, the value is what you derive from owning it, the joy of driving it, the ability to take the kids to school, the ability to get from point A to point B. And just like when you buy a car, the price of the car has a link to its value. You know, if you overpay for the car, then it's likely to never return in value what it cost you. But just because it's cheap doesn't mean it's going to be good value. You know, a cheap lemon that you spend thousands of dollars a year with the mechanic fixing is a bad investment, it's bad value. On the other hand, an expensive car that runs well for 10 or 15 years can be great value, or a sports car that you enjoy driving can be great value. And I think that's the challenge. What we really mean by value investing is that idea of buying something to hold such that it returns you more than it cost. That's the value element and investing.
So let's get into it then, and start by just asking the basics. What is investing? What's the investing part of value investing?
Great question. So really anyone who's in the market is participating in one of three ways. They're either a trader, that means someone who's looking to own an asset for a short period of time and benefit from changes in price. A speculator, someone who's looking at a big theme and trying to take a bet on whether that theme plays off or not. You know, is gold going to go up? Is gold going to go down? What's the RBA decision going to be? You know, things like that, unrelated to the underlying asset itself, but as a broad theme. Or an investor, someone who's looking to own an asset on the basis that that asset over time will deliver them a return, either in the form of regular payments, think dividends or debt instrument coupons, and ultimately, hopefully, a very nice capital gain.
So where's the value and when you're putting it together?
Well, the difference is simply between value and price. So price is the cost of undertaking a strategy, what it costs me to acquire an asset today and what I can get for that asset in the future. And value is simply the objective answer at the end of the day of, was that good? So anyone who's investing, I would argue, is a value investor, because what they're trying to do is acquire an asset today at a price that means in the long run it will have delivered them a wonderful return. And the key there, of course, is time. That's what separates investing from trading. And value meaning it worked out in your favor.
All right, so what we're going to do then is take a look at some of the, from my understanding, there's three different ways in which you can value invest, generally speaking, right?
Yeah, I think the market of value investing, or people who do value investing, break down into three main categories. There's the Benjamin Graham deep value or cigar butt approach to investing, which is the idea of trying to find something that Mr. Market has completely mislabeled. Think of it as going into an antique store and seeing a mislabeled Van Gogh. You're trying to find an asset that clearly is valued incorrectly because people don't understand it. The second group, and more common group of value investors, are what we would call growth investors. So they're people who look at a company or look for any asset and say, if I can own it and add value to that asset, or its management team will add value to that asset, then in time it will be worth much more than it's worth today. And then the third group is the Warren Buffett and what we fall into in Teaminvest style of investing, which is to say both of those have a lot of sense, but they're a lot of hard work. In the case of the Benjamin Graham side, it's just very hard to find them. There's not a lot of mislabeled Van Goghs going around in the world. And in the case of a growth investment, this takes a lot of work, right? Like a management team or you as the owner have to do a lot to create that value that the market doesn't see today. So what we're looking for as a Buffett investor or a Teaminvest investor is an asset whose management team has already done the hard work, and yet for whatever reason, the market is not rewarding it fully. So that doesn't mean the market's not saying this is looking good. It just hasn't really worked out how good it is today. Think of it as a completed home on a street that the market is still pricing as if it was the old knockdown before the renovation.
Interesting. Now, when you are thinking then about, the real metrics that help prove up something being value as opposed to just being a cheap stock, is there a handful of things that you look to most commonly?
So I think the first question is it a good investment? And being a good investment really relies upon the underlying asset being strong. So no matter what asset you're looking at, and we'll talk mostly about stocks, the first question to be a value investor that you have to answer is this an asset worth owning for a reasonable length of time? Because if you're an investor, time is critical. Longer time is better than shorter time. And therefore, if it's all smoke and mirrors, it's unlikely to prove good value in the long run. So the asset has to be of quality. And then the second thing is, in the term value investing, the common sense one, you have to buy it for a price that's reasonable. Because if everyone knows it's a wonderful asset and the price for that asset is very high, it's very hard to achieve a good investment return. It's still a wonderful asset, but it won't pay you back any reasonable return on your capital. So we're always looking therefore for really two things. What is our definition of a good investment? And that will differ for certain people, but there's certainly 27 research-driven reasons where we know something is a good asset, and people will assign different values to different parts of those. And then secondly, is it going to be good value? Is this price that I can acquire that asset today likely to give me a good return over the long run? Or has all the future value already been factored into the price today, in which case it's still a wonderful asset, but it's a bad investment.
How does value investing work in, say, momentum-driven markets, or when you've got these massive thematics like AI that are just dominating?
So I think, interestingly, AI and momentum-driven markets are really forms of either trading or speculating. And there's nothing wrong with them if you can do them well. So what I mean by that is a momentum investor or trader is really trying to take advantage in short-term changes of sentiment. The market is positive. If I buy the asset now, it'll be more positive tomorrow, and I can sell it for more than I paid today. They're not taking any underlying view on whether the asset itself is good. The same thing with a speculator. A speculator is taking a bet. Now think of it like horse racing, right? That my horse will come out ahead, AI will change the world, and any company associated with AI will be a big beneficiary. If they get it right, the returns are large. But if they get it wrong, the returns are very, very, very low. Because it's a bet, right? The outcomes are binary. And I think that's the big thing that separates investing from speculating in that sense. So investing and trading are separated based on time. Short-term holds, trading, long-term holds, enough for the asset to do something, that's investing. The difference between investing and speculating is there's an asset that has value regardless of the outcome in investing. The question is just how much is that asset worth?
Andrew, we've just brought a table up here. Please explain what we're looking at here.
So this is just a simple table where I said, let's have a look at the 57 companies on the ASX that this time last year, beginning of February, passed the minimum requirements that a value investor would look for. So what we really mean there, a company with a high degree of return on equity achieved with little or no debt that's growing at least some degree faster than inflation. And don't put price into the equation at all. So just simply, is this a reasonable business that may be worth owning? Of course, being an investor, you want to own the business. And then what we've done in that table is broken it into three categories. What would have happened over the course of the year since then if you had bought the cheap ones, those on a PE of less than 15 times, the sort of reasonably valued ones, 15 to 35 times, and the expensive ones, the greater than 35 times. And as you can see from that table, in the case of even any of those sort of reasonable priced companies, the average expected return over that year, or the average return you would have had over that year, has north of 20%, which compares to the market in the same period of about 4.5. So about 4 to 5 times what the market did. On the other hand, buying that same wonderful business, or reasonable business, I didn't even check if they were wonderful, I just said, are they reasonable? But paying a high price for them, surprise, surprise, as common sense would tell you, delivered a pretty anemic return, a negative return. And that's really all you're trying to do in value investing, is ask some common sense questions. Is this an asset I'd like to own for whatever reason? And each person will have a different view on that. And then based on whether it's a reasonable asset to own, is the price fair? And if so, a reasonable asset with the power of time will become a great investment. If it's the wrong price, it'll still be a reasonable business, but it'll be an awful investment.
Well, let's take a look at some of these companies in depth now. We'll take a deep dive. Let's bring what is a value conversation to stocks and consider three companies we are consistently asked about by you, being Coles, CSL, and Life 360. We'll do it as a cigar butt investor, a growth investor, and a Buffett, or let's call it a Teaminvest investor. All right, Andrew, so let's start with taking a little look at Coles from a cigar butt perspective. So I suppose, what does the balance sheet tell you?
Well, really, I think the first comment is being a cigar butt or deep value investor means you have to run through a lot of balance sheets before you find anything that looks particularly exciting, because you're really looking for the market getting it materially wrong. And if you take the Benjamin Graham example, just because we're using that, that really means looking at the book equity per share or the net tangible assets per share. So the balance sheet of the company, what are the assets worth to an accountant if they were sold today, on market in a fire sale? Went to Gray's Online and sold everything. And how does that look compared to the share price? And of course, if it looks like you could sell all of the assets at an auction today for more than the share price, that's a good investment. And if it looks like they would sell for less than the share price, then there's risk and it's a poor investment. And it's no surprise that all three of the companies, and we can run through them individually, probably don't look that good on that metric, because just simply of the 2,000 companies on the ASX, there's probably no more than a handful that look good. In the same way as there's probably only a handful of mislabeled Van Goghs. If we have a look at Coles, Coles has got a book equity at the moment of about $3.8 billion, 1.3 billion shares outstanding, and so a book equity per share of $2.85, which obviously, compared to its current share price of around $21, does not look attractive to a cigar butt or deep value style investor. And it looks even less attractive on a net tangible assets basis. So, of course, net tangible assets is just simply the book equity less goodwill and intangible assets, things that don't really exist other than in an accounting world. They're not tangible. And so from that point of view, Coles, despite being in many ways, I think most of our viewers would think a wonderful business and well-run business, looks pretty poor from a deep value perspective. But again, as I mentioned before, I don't think that's an indictment of Coles. That's the problem with deep value. You find very, very few that meet that criteria.
What about CSL then?
Similar problem. I mean, CSL has a higher book equity per share because they've got 30.5 billion roughly dollars Australian of equity and 484 million shares outstanding, so about $63 a share of book equity. But again, they're trading on $180 at the moment. So from a deep value perspective, there's more value there per share than Coles, but nothing to be excited about. No reflection on CSL, the company. It's the challenge of using a deep value approach.
Okay, all right. So Life 360 then, I can't see that would be deep value for really anyone.
Yeah, I mean, same kind of problem. Interestingly, as a proportion, it looks better than Coles, purely because they've got a lot of cash on balance sheet from recent capital raises. But again, material 70+% discount of book equity compared to current share price. And I think that's where value investing has historically sometimes got a bad name, because if what you think of value investing is simply look at the balance sheet and ask, are the assets in a fire sale worth more than the share price, it's no surprise that when it arrives it looks good, but it's bloody hard work. There's not a lot of them out there. And so from that point of view, it can be very rewarding when you find them. And remember, Benjamin Graham was writing during the Great Depression, so there were probably a lot more opportunities. But in a more normal market, there's really only a handful of opportunities any year. And they're often in the really micro cap range.
Yeah. So this is a fun game. So then look at these three companies, Coles, CSL, Life 360, through a growth-focused value investor lens.
So I think the biggest thing we're going to have to do then to do that, and I've thrown together a little bit of quick analysis for the viewers, is in order to be a growth-focused investor, you're going to have to make a couple of assumptions here. And this is where brokers and talking heads and things can make a lot of money, right? Because if you're going to have a view on what's the company worth down the line because it's growing, you need to get an assumption around how fast is it going to grow and how long can it sustain that growth for. And then what you can do, of course, is have a view on value. Now, I have a mathematical background, and the problem whenever you're forecasting things for a very long period of time is the maths becomes very unstable very quickly. So what I mean by that is not that the maths doesn't work. The maths works really easily. The problem is that very small changes in your assumption can result in very wide deviances in your outcome. So if you have a look at, let's take Coles to start with. If we have a look at Coles, Coles is an incredibly stable business. I mean, it sells a staple product to pretty much every Australian. It's got pretty much all the market that it can get. You know, it really can only grow with inflation and population growth. No surprise that Coles has a very high degree of stability of its sales and earnings. So it's a really easy company to forecast, in theory, right? Great stability of earnings and sales, no real moats that are under threat from a competitor, management doing a good job, unlike its major competitor in Woolworths. And so from that point of view, it should be really easy to forecast. But depending on whether you use a future growth rate of 3.3%, roughly inflation now, or 2.5%, the midpoint of the RBA target, you get a pretty different answer. Now, in the one case, you get an answer that Coles is worth $25.56 a share and looks cheap. And in the other case, it looks pretty much the same as its current share price. So the question then becomes, if you're a growth value investor, which of those assumptions is right? You know, if 2.5 is the correct number, don't buy Coles. If 3.3 is the right number, back the truck up.
Yeah.
And as you can see, therefore, you've got two big challenges that are going to come in as we go through being a growth investor. The first is, how accurate can you make a prediction? That's why we pay lots of money for broker consensus, right? If you're a growth investor, because you're trying to get a really, really good answer around what that future percentage should be.
Yeah.
And the second problem you're going to have around places like reporting season is you're likely to be often surprised, because it's that classic thing of no matter how accurate you are in the long run, you can be almost damn well certain that somewhere along the way, it's going to miss it. And that's when we talk about earnings beats and earnings misses and the huge shifts that growth investors can get in value around that.
So is there anything dramatically different through a growth lens when it comes to CSL or Life 360?
Yeah, great. Well, let's pull them up. So if you take CSL as an example, I mean, CSL is growing a little faster than Coles, somewhere between sort of 4 and 7%, and you get the same problem. In this case, thankfully, because CSL looks so cheap at the moment to a value investor, it probably doesn't make much difference.
Yeah.
But whether you assume a 4% growth rate, in which case you get a value per share on these assumptions of $320 a share, or a 7% growth rate, in which case you get $400 and something a share. The challenge again is which is right and how long will it take you to know. Now, if the gap's big enough like this, a growth investor would take a look at CSL and say, well, there's almost no scenario in which I can lose. So they'd be quite happy. But it gets particularly interesting if you want to take a company that has more uncertainty. Something like Life 360, which you mentioned before. So in the case of Life 360, and I've been on these programs mocking Life 360 as an investment a few times because of the uncertainty. But if you just want to think about that from a growth perspective, you can see why, as a growth investor, Life 360 is both so seductive and so scary. So it's seductive because it's growing at the moment at a rapid click. There is no doubt about that. It's growing user numbers and revenue at something around 20 to 30% per annum, which is astronomical. The question becomes, which of those is right? Because as a growth investor, if you assume it grows at 20% per annum for the next 10 years, it's, at the moment, a bad investment. It's worth about $20 a share compared to a current market price of $27.40. So you'd lose money owning Life 360. And on the other hand, if you take the top of the range, you say 30% for the next 10 years, it looks like a steal. It's worth $43 a share compared to a current market price of $27. Now, the challenge for anyone doing that as a growth investor, of course, is how are you going to know, is it 20% or 30% or any other number for the next 10 years? If you can make that prediction with any degree of accuracy, good luck to you.
Well, my crystal ball is just a little cloudy when it comes to that. So then wrap it up in a bow for me here. If you are a Teaminvest / Warren Buffett inspired investor, how do Coles, CSL, and Life 360 stack up then?
So I think the first step to do is to say Warren Buffett was incredibly smart. I mean, clearly from his returns he is. But because he worked out something pretty early on that all of us have been able to copy and refine since, which is he said, look, being a Benjamin Graham investor is really hard. It's very, very rare that you find something that the market has got completely wrong. And the only way you can really do so is if you pour through the really tiny end of the market, where there's less people looking, and you know a hell of a lot about each type of industry. So it's a huge amount of work, because you've got to find that misattributed asset. The problem with being a growth investor, on the other hand, is it looks really seductive, but if you have any degree of certainty, you're almost certainly going to be proved wrong. In other words, to be making long-term predictions about companies that are run by people in markets that are changing all the time, the maths works really well, but the reality is it's very, very hard to do. Even running the business yourself, you're not going to get a good forecast. So how can you get a good forecast when you're seeing it at one remove? So if you want to be a value investor, you have to find a way to take advantage of the common sense of value investing without all the hard work and difficulty that comes with being either a deep value investor or a growth investor. And so what he and Charlie Munger worked out and did, and others have built on since, is to say, start with first principles. There is no point in trying to value everything. Not everything is valuable. Some things, like Life360, may have too much range in your ability to predict, to have any reasonable idea. So ask the really common sense question first. Is the asset you're about to own worth owning at any price? Doesn't matter what the price is. Is it just a good asset? And you can test that really quickly. We've got some charts for these companies, but for example, the first question to ask is, are earnings growing? And are they growing stably? That's the sign of a good business. Has return on equity delivered? That's the sign of a moat. High return on equity says the business has a competitive advantage. So that means the earnings are likely to be able to continue growing because they're protected. And is the balance sheet strong? Is the debt to equity a reasonable level? And only after you've asked those questions, have a look at the question of price and stop trying to think about valuing things using a mathematical approach out to infinity, and ask simply, with a margin of safety, does this look like it could be good? And so what Buffett really talks about there with a margin of safety is have a look at it compared to the market average. Because a wonderful business trading at less than the market average is probably a good business to own. It's a good investment. A wonderful business trading at many times the market average is probably going to, in the end, have gravity reassert itself. And so from that point of view, we've got some charts of these three and we can run through them. How do you do that? So if we have a look at Coles first. Coles' earnings per share have grown, as we said, pretty stably in line with inflation. Yeah, good business, no question about that. Its return on equity is around 30%, pretty spectacular for a grocery business, and that speaks to the huge moats and competitive advantages that Woolworths and Coles have. It's got quite a bit of debt at the moment. That would be too much for someone like me, but you might say with a business that size, it's a sustainable level. That would be a choice. So now that you know that it's a business worth valuing, and one that you can value because it's stable and it's got a moat, just ask simply, how is it trading relative to the market as a whole? And as it turns out at the moment, Coles is trading on a PE of 26.4. That puts it in the top quartile of its own trading history, so towards the expensive end of when it's ever traded, and well beyond the market average of about 20 times. So as a result, what you would say as a Warren Buffett or Teaminvest approach, Benjamin Graham, you just say book equity, but as a Buffett or Teaminvest approach is you'd say this is a good business, potentially too high debt, but a pretty good business, but not trading at a reasonable price. And so you'd stay away. CSL, on the other hand, you'd say earnings per share growing much, much faster than Coles and with a very lovely steady path. So tick for earnings growth, it's a good business. Return on equity very high and declining debt, so strong balance sheet, strong moats, and available on a PE at the moment of 19 times, which is right at the bottom of its 10-year trading history and well below, or sort of in line with at least the bottom end of the market average. So looks like a good potential investment. And then Life360, of course, the challenge would be trying to make any assumption about the future. But if you did that and you guessed at whatever you thought the growth rate was, you could run the same approach. The challenge with Life360, of course, would be, well, can I even say it's a good business? If you look at its earnings per share history, it's only made profit once in its entire history. Now, there are reasons for that. I don't want to be rude about Life360, but if you looked at the sales and earnings chart, to try and make any prediction about where earnings or sales would be very difficult. If you look at return on equity, it's negative, so what moats does it have? And then, of course, valuing it, you could look at the PE, but I would argue after the first two questions, it's too hard anyway. Move on.
Okay, so that is a good look at Coles, Life360, and CSL through those different value lenses. All right, let's get to your questions. Each week, the team will answer one of your questions, and if you have a question you'd like answered, please send it to wealthy@ausbiz.com.au. And today's question comes from Mark in Queensland, who writes, with reporting season kicking off, how should value investors be reading the results? Is it more about earnings beats, outlook statements, or balance sheet strength? Andrew Coleman from Teaminvest, what do you think?
It's a great question. I mean, really, for value investors, and probably all investors out there, the 2 reporting seasons a year in Australia, the half yearly and full year, are critical times. But they're critical times for different reasons depending on the style of value investor you are. You know, if you're a deep value investor, one would argue that the reporting season matters because you get to see what the state of the balance sheet is. And that's really all you care about. So, Mark, to your question, if you're a deep value investor, have a look at the balance sheet, have a look at the net tangible assets and net assets per share, and it's probably a very quick exercise, and move on. You probably won't find much, but it's a quick exercise. On the other hand, if you're a growth investor, this is where that comment around consensus beat comes in. And I'll start off by saying that I think most people with a mathematical bent start as growth investors and very quickly realise it's not worth the effort. So what do I mean by that? We said before that the assumptions you put into your model result in really big swings in valuations. And so you're going to get this problem if you're a growth investor that twice a year your model is going to be wrong. The question is how much wrong? Because you're going to have assumption around future growth. The company's going to report. They're going to give you 2 numbers. The number that they just did, the number that they think they'll do in the future, and if you're someone who cares about analyst consensus, you'll get a 3rd number, which is what do the analysts reading those reports think will happen? Which of those do you now plug into your model? That's hard. And I'm naturally lazy, so not only is that hard, but it's more hard work than I'm prepared to do. On the other hand, if you're a Warren Buffett or Teaminvest style investor, it's actually a lot easier to do reporting season, because what you're really going to do, I think, is look only at companies that you already think are wonderful businesses and ask yourself a couple of really simple questions. Number one, has anything happened to change my view? In other words, have they done something that now makes me think they're not a wonderful business? Because if they're still a wonderful business, it hasn't changed that element of the equation. So I can take a quick look at earnings, a quick look at return on equity, a quick read of the CEO report, and if they haven't said something crazy, and sometimes they do, then nothing has really changed. And because I'm not trying to make an assumption around future growth, the rest of it is kind of meaningless. All I need to ask is, have they done something that makes me change my view? And then secondly, does the market overreact in some way, positively or negatively, and create an opportunity for me to buy it?
It's really fascinating. So how do you stop yourself, though, Andrew, from getting pulled in by these short-term, really severe share price reactions?
Terry Pratchett said famously that wisdom is the result of experience, and experience is usually a result of a lack of wisdom. So let's just say the easiest way I have found to avoid getting caught up in it is because I got caught up in it in the past and it hurt a lot. And I think that's the reality. I think being a value investor is difficult for 2 reasons. Number one, common sense is unfortunately...
Not common.
Exactly. So whilst theoretically being a value investor, certainly in the Teaminvest or Warren Buffett style, is easy, just ask, is it a good business and is it a reasonable price? We as humans can get in our head to try and convince ourselves everything different. You know, I played a lot of cricket when I was younger, and I was told very early on about the apocryphal comment attributed to Don Bradman, which said, cricket is a very simple game made difficult by those of us who play it. And I feel like value investing is the same. It's a very simple game, but often made difficult by those of us in it. And I think the second thing then is you need to put your ego aside. I think that the challenge with value investing is sometimes to say, whether I have a belief in the future being different or not, my best result based on research is saying the future is going to look like the past. So a company that has a strong track record of performance, it's likely to perform again in future. A company that's never done well in the past is probably never going to do well in the future. And that's hard to do, right? Particularly when we're on programs like Ausbiz and we're being asked about these companies and we meet the management and we get to like them and they're doing something that's really wonderful for the world. It's really easy to get caught up in that cycle that says, this time it's different. This time it's going to grow much faster than it ever has. The turnaround will turn. The AI will change it. The commodity price will get to $10,000 for gold. But it tends not to be true. And the fascinating thing about that, and the stat I always come back to, is this one, and it's what makes it, I think, very easy for me to be a value investor. We've got a 25-year track record at Teaminvest of delivering north of 15% per annum returns. Warren Buffett's got a 40-year track record of doing that. Peter Lynch, 20-odd years as well, by using common sense. Traders, on the other hand, we've got the stats. Only roughly 3% of traders make a profit, and only 1% of speculators make a profit. So if you think that you can make better guesses than these speculators and traders, you'd better hope you're in the top 1%, and my ego is not good enough to convince me of that. And then the other stat, which I'll leave with because it always goes around in my mind, is a very famous study by the two American authors, Dremen and Berry, in the late 80s, early 90s, where they looked at analyst forecasts 1 quarter ahead in the United States. So in the US, as you know, we do quarterly reporting. And they looked at analyst forecast of earnings growth 1 quarter ahead and found that analysts were materially wrong 80% of the time. Now, I don't think that's an indictment of analysts. I think what that is an indictment of asking people to forecast the unforecastable. It's not possible to know what earnings are going to be a quarter ahead for most companies. They're too volatile. So to get into that game of trying to forecast it and trying to guess, you can probably charge very large fees for your advice, but you're not going to make a lot of money as an investor. Stick to the basics. Is it a good business? Is it a reasonable price? And assume the past will continue. Surprise, surprise, it's hard to go wrong.
All right, well, let's pick this conversation up next week then. Andrew Coleman, Teaminvest, thank you very much.
Thanks for having me.
And thank you for watching this first episode of Wealthy and Wise. I look forward to seeing you next week.
Wealthy and Wise is your guide to value investing, powered by Teaminvest.